All right. Good morning. Good morning, everybody. Often called Easter Monday. We had a long weekend. Hopefully, you did something productive with it. There is a historic precedent for this day to be a low participation day. We'll see, right? There's always history and context that we can use when looking back at the market, and then there's the current situation with all headlines over the weekend, a lack of solutions to the issues that we faced going into the close last week. We could very well see some active traders today, a lot of participation. That score right there certainly highlights the lack of participation, right? When we've been running in 100,000s and even higher than that, 200 and 300,000 in the overnight hours, looking at 44,000 this morning, kind of reinforces the idea that it's a low participation day. And of course, that is where some of the biggest moves can happen, is in lower participation days. So we're a mixed bag looking at what's going on around the world, mostly red, leaning a bit heavy in tech with the NASDAQ down almost 1.5%, S&P 1.25%, then the small caps and Dow down the least at just 1%. We do have some auctions in the front end this morning. This is like the IRX. Would never want to deliberately ignore data, but these auctions aren't necessarily going to bring any surprise, or at least they shouldn't. Definitely want to pay attention to the other two time frames when it comes to bonds, if they list any. Then just assume that the other two times do as well. So 11, 11:30, and 1 o'clock. We see some here listed at 11:30, so we'll just assume that 11 and 1, there's something else going on. I think one of the big things today is just going to be trying to keep everything calm, keep everything stable. We had the VIX gap up again. Critical line in the sand right now for this was supposed to be 31.5. Now that we've gapped like this, though, 33 on the upside and 29.5 on the downside. We're trying to find that sweet spot between what's happening here, what we see happen in the broader markets. It's not just whether or not it's going up or whether it's going down. And we've got the dollar below 99. You can see this base that it had developed before it fell out of bed. That's a classic shape right there. Don't got a matching move this time. Got the 10-year moving in the other direction, headed towards 4.4. So dollar down, S&P down. This is going to be one of the biggest things today, right? That right there. That and the 10-year. And headlines. We don't really have any normal everyday economic events today to worry about. So wild headlines that come out that we can't predict coming. The 10-year and the dollar. These are going to be the best tells for what's happening on the day and whether it's going to get any better or not. And then, of course, bring in the VIX with some swag levels of interest. $52.30 for the put wall. We're breaking out of last week's low. And now that we're out, we kind of want to keep it. If you're a bear looking to continue the move to the downside, you do not want to see this come back in again. Right? Once you get a breakout, you want to keep it. We got 52.23 as a liquidity zone. And if we don't turn back there, we make it through the put wall, then we've got 51.92 cog line. And of course, there's 52.11, 52.32, 5200. All of those levels are levels of interest. $51.80 is still the midpoint of this big week. This is the level that we need to hold. If this is the end of it and we're supposed to, bounce here, start setting higher highs and higher lows, we don't want to see it drop below 51.80 on a close. Now that's a weekly line, so it's a weekly close that we're talking about. During the week, we can cut down below that as long as we rally back up and close above it by the end of the week. If we don't, then we start focusing on lower levels and a revisit to previous lows. I kind of expected the volatility trigger in zero gamma to be closer to us at this point. We'll see what Spot Gamma has to say this morning in the AM edition of the Founders Note. They could shine some insight on this, but I wouldn't be surprised if we see those levels come down. Right? And, I don't know how much we can expect out of it, but I would expect at least a couple of 100 points. Otherwise, we're below all the major moving averages, nothing to get hung up on with those. The ADR is so wide right now that even though we're down 1.25%, we still haven't hit one side yet. So with that in mind, to hit the upper ADR would be hitting like Wednesday's midpoint or a little higher than the mid. It would be completely outside of Thursday's range. So we would have to travel all the way back up through Thursday's levels, its midpoint and everything, and then get a breakout to get to that. While technically that's possible, it's very unlikely. So that puts us in focus of the lower ADR, 51.88, really close to the 51.92 cog line. The average daily range right now, 191 points. more than 3.64 to the downside. From where we opened Sunday night, if we move in a single direction, 3.64% will make it to the 5092 cog line all the way down here. But that number is supposed to be divided between these two positions. So if we only go half of that distance, we'll get here, 5188. Half is more common. It's what we expect on a day-to-day basis, right? Is that when you have an expected move range, you can track the edges of both sides, and between the two red lines, you get your full day's ADR. But if the market collectively just jumps on the bandwagon, you can go really strongly in one direction and you can get the full ADR up or down. And that would get you to the yellow lines. Breaking below last week's low, like we have, is the start of this. So if we don't turn around in that liquidity zone that I had marked out, then it's very likely we're going to 5188. And then we'll reevaluate at that point and focus on the next cog line lower. This week's channel, 5358. The weekly channel is higher than last week's channel. That's considered bullish, but we opened underneath it, and that's considered bearish. It is the channel for the whole week. It's a narrower channel compared to last week, but it's still fairly wide given how narrow it could be. Today's floor pivot is actually giving us an example of how narrow the channel could be. This one's so narrow you can't even see it as a channel. It just looks like a line. A narrow channel implies that if we break out, it could really grow legs and run, whereas a wider channel implies if we break out, it likely fails and we come back into the breakout zone. Now, these channels don't make price do anything. They're just giving us some insight on what to expect if we did get a breakout. And we did get a breakout, right? That's not even a discussion of if we will. We broke out of Thursday's range, and we continue to expand to the downside as this narrow day channel tells us we should expect. So far, we're right on schedule. And we've made it to S2, support level 2. And generally speaking, this is where we would expect this move to end. Right? Common moves, especially in the indexes, you know, the way that these floor pivots are utilized in the index is completely different than the way we would find it in equities. So in a support level 2, we're very likely done, and we would focus on getting a move back towards the central point or the floor pivot, and or just not expanding any lower. If we do expand lower, the next level down, 5150. Of course, we've already talked about the cog lines and the ADR levels. Support level 3 would be the next stopping point. It's about 2.5% from where we opened Sunday night. It's more than 3% from where we closed on Thursday night. So it still doesn't hit our full ADR, depending on which one of those you want to use. double distribution week with the point of control in the higher area, that 5450 area. Any attempt to make a run back up, we're going to have to deal with the first distribution area, be through this zone here, right underneath 5350. If we can get through that one, it does get really shallow. This shallow area makes it easier to travel through that zone, which would get us up into that 5450 area. Right now we're getting a little help from back here, but it's not going to sustain, right? We can see on this week, last week, there wasn't a lot down here, right? So when we got here again this morning, there wasn't a lot down here. We went right through it. And we get into a shallow area from here. So breaking down below last week's low starts us on this trip where it really starts to get narrow, and we can travel through narrow zones relatively fast. Just got to get through the 111 at this point. $10-day 30-minute volume profile with TPO. TPO's in blue, volume profiles in green. It's not likely to see a shift in the point of control here for a couple of days at least. The only thing that could move it faster would be if we stay in one spot and build out a lot of volume really fast. And the closest ones that could do that are higher than where we are right now, right? We could build out that 5400 area or 5450. Either one of those could be built out relatively quick. Otherwise, all of these are much farther behind and, well, just lower down too. So if we can get to 5200 and put in a lot of work, we could build that level out. Below that, we've got 5150 and then just straight up 5,000. We'd have to get there, stay there, and build the level out enough to move that point of control down. Otherwise, we've got this significant level of resistance that's going to be over our head for the foreseeable future. Most of the week, at least, if we don't get it moved down into one of these other levels. And we're not likely to do that on a low volume participation day. Got a new VPOC from Thursday, so that'll be something else over our head to deal with. Seems like it's right around the cog line, 53.32. We'll get it lined up, but it seemed close. Yeah, no. Nope, underneath the cog line. 53.27. So a run to the upside. First, get back inside of Thursday's range. Cut through the VPOC. Test yesterday's RTH highs, then the Globex highs or the full high, which happens to be an old VPOC from last Wednesday. They really came in and put a lot of work here, and it doesn't seem to be holding. We're about to break down even after they put in all that work. This is like a little bit of a liquidity event, and we would expect to treat it like a liquidity gap. That should have been a pause and a little bit of a base, and then we should have gone back up to close the gap, and we did not. We can see they're putting in all this work, and it's not holding. This isn't looking like it wants to hold anything. So we didn't have the new week's levels on Thursday. The indicator is not smart enough to realize that last week was a short week. So on Thursday, it wasn't giving us a new week's projection, which is typically what we would see on a Friday. So we can measure last week's range, and then we can compare it to this week's range. And it's not really a fair comparison because last week was a 4-day week. This is a 5-day week. This week should be bigger than last week's range because this week has 5 days in it. That's simple enough, right? But we can see from the box that this week is narrower than last week. It has more days, more time to travel, and yet we don't travel as much. It's a narrower range. That implies the market is pricing in a pause. A little background on that. Somebody once said that FOMC is volatility suppressing. The first time I heard that, I thought, what? Are you a fool? Have you never seen what happens on an FOMC day? How violent it is and the big moves that we get? But the person is absolutely not a fool. They were talking about before FOMC. FOMC is typically on a Wednesday. What happens Monday and Tuesday and half of that Wednesday before we finally get FOMC? A lot of times, nothing. We tighten up into this narrow range. We don't really go anywhere. Maybe you start building a little bit of a megaphone pattern and we wait because it's volatility suppressing. Something is on the horizon this week and the market is expecting a pause. They're pricing in that pause in price. Even with all of the violence and the really big moves and the 3.6 ADR, the market this week is saying, yeah, we're likely going to hold sideways and wait on something. Not quite sure what that something is. We are really close to the QRA. We're close to an FOMC. We've got big earnings. But this is a signal that we're expecting something really big, and that before we get whatever this big thing is, the market very likely will chop sideways. At least that's what they're pricing in. Now, we've seen those weeks where we have an FOMC event and everybody's expecting it to be sideways for 3 days and we wait. And then on that Monday, we get these really big, wild moves. Well, Monday and Tuesday, and then Wednesday, we go sideways before FOMC. So, just because most of the time FOMC is volatility suppressing, it doesn't have to be. Like right here, that was a Friday close. We opened on Monday, gapped down, fell completely outside of the week's range. And then Tuesday, we really didn't do much. And FOMC on Wednesday, we really didn't get much done before Thursday. Friday is sideways. So just because it's an FOMC day, or just because it's a week where they're pricing in a lack of movement, that's what a lack of movement would look like. That was also an FOMC week. A lack of movement, same thing. So, it's what we're expecting. Here's another example where we could make really big moves on a week when we're not expecting to make really big moves. But it is what the market is pricing in. So we want to, really focus on that. 80% of the market is going to do what the S&P and the NASDAQ are doing. If we're expecting to hold the range and go sideways and really not expand, that would be the base case argument for, a good 60 to 80% of the market. sounds a lot like defense, keeping what we took, holding the line, not really expanding too much to the downside, making it through another week, putting in some stability down here. The curve, if we look at how far we are from the 10-week, is moving back down. So we're outrunning the 10, not by a lot, but we are outrunning it. We're moving faster to the downside. And our distance from the 10-day is 2%. We had a nice reset, got back above it. Now we're headed back down below it. We can run these waves for a while. Where we just crisscross back and forth without really getting too extreme. It's a bit of a healthy thing to get this crossing back and forth. Just kind of holding the line and building stability. We don't really want to get more than 2.5 or 3% away from the 10-day. Then it can start to compound on top of itself and really expand to the downside really fast, like we did back here. No, it's too early for QRA. That's going to be near the end of the month into May, but it's coming up, right? But no, it wouldn't be this week's. And QRA is going to be a 2-part event, right? There'll be a Monday event around 2 o'clock, 3 o'clock, and then there'll be the Wednesday morning event. All right, looking at things that are down this morning: healthcare, energy, biotechnology, the Mag 7, financials, value, consumer discretionary. It's really the whole list. The mags, chips, tech, bonds. Just about everything is down this morning. If we look at what's up this morning, we got China up and Bitcoin and gold with gold miners. Or we should just say gold miners and junior gold miners. That's not going to get it done. Oh, and pot stocks. Yeah, that's not going to help either. You know, we treat Bitcoin as a bit of a liquidity tell and a risk appetite tool, right? If they're willing to accept risk and they're feeling frisky, they'll jump into Bitcoin. That's not always the case though. There's other times we see it move where it's not such a representation of risk or risk appetite. And that usually comes from some of the constituents that it's made up of, or that buy it, hold it, trade it, use it. The Bitcoin proxies. So we do have China up a little bit, and solar, which is generally up when China's up. Precious metals and Bitcoin and pot stocks. That's not the kind of rally that is going to move the S&P and the NASDAQ today. It's also not very defensive, but gold is going to be a great tell at this point because of its connection with hedging and risk and the increased margin requirements for trading it. So if we see them starting to dump gold today, that'll be a little bit of a tell, and it should match with a continued breakdown of the S&P or the NASDAQ, right? We're talking about what happens if we break down from here, get underneath the put wall, and it starts to get, a little scary at -2.25, -2.5. If we get below -3 on the day and we start seeing gold sell off, that could get a little extreme. We're not expecting that, right? Markets move in a controlled manner. It's very likely we won't see lock limits today without some wild headlines to get us there. Just keep in mind the lower participation means that we can make bigger moves. So it's what I got for you guys. Be careful, be safe, mark your levels out, watch your headlines. I'll see y'all tomorrow.